side, we're not referring to volatility, which is an academic definition that the industry often uses. We're referring to what is essentially a permanent risk of loss, not temporary ones. Nobody would worry about temporary ones. That really, those aren't a big deal. We're really talking about the permanent risk of loss. There are three key drivers of whether or not an investor can experience permanent loss. The first is valuation risk. That's essentially paying too much for something. Business risk is what you've invested in fails or performs poorly for some reason. And then financing risk, and that's really leverage. It's speculating. It's how do you finance your investments. In the investing world, risk and reward go together hand in hand. On the next page, there's just a visual of this. Risk and reward is a continuum where you've got one level of extreme loss or devastating loss on the one end, and then you move to an uncomfortable loss, unfavorable, and then it becomes favorable, and then you have maybe spectacularly positive results. The greater the expected reward, the greater the implied risk. They go hand in hand and cannot be separated. Our emotions coincide. They run along the continuum, aligning our worst fears with risk and our greatest hopes with spectacularly positive rewards. Supporting our perception and understanding of risk and reward, fear and hope, are the way that we cognitively process information and our emotions or intuition. So now we're going to dig a little deeper into our assessment of risk and reward and how that assessment ends up wrong. The next page is a quick glance of where we'll go. What we'll cover in how we assess risk and reward and how we get it wrong. And in particular, we're going to spend time on three areas. Cognition's influence, which is what we'll be talking about is largely the survival kinds of skills that mankind has had for millennia, the hardwired kinds of aspects that have lent to our survival but sometimes cause problems for us today. We'll spend time on emotions. They do matter, and risk is felt as well as analyzed. And then we'll look at where failure in emotion and failure in cognition intersect. And that's when fraud occurs. We've had a dramatic failure of those two things working. We're all familiar with the phrase, the elephant in the room, but how are we with gorillas? We all have a tendency to believe that we pay attention to things, that we can identify what's going on with cause and effect reasonably well, and that we interpret the world pretty accurately. The truth is, however, that we're susceptible to processing the world not quite completely or correctly, and the limitations that we have cause problems for us in areas ranging from assessing risk to having to testify in court on the sequences of an event. In the late 1990s, a couple of Harvard psychology professors and their students put together an experiment that became one of the most recognized experiments in psychology. It's been popular for professionals and individuals alike because we learned something unexpected about ourselves. I want to describe the experiment to you briefly. They put together a short film of two teams of students, one team dressed in black shirts, one team dressed in white shirts, and they're in kind of a small area and they're passing a basketball around. Each team is. They're moving around. And after they got this video ready to go, they sent the students out onto the Harvard campus and asked for volunteers to look at the video, and the volunteers were told to count how many passes, how many times the white team, the team dressed in white, passed the basketball. The video lasted 1 minute, and then that was it. It was a very simple experiment. As you might imagine, the researchers weren't really interested in how well people could count how many times the basketball was passed. They were actually testing to see if the volunteers noticed anything unusual while they were counting passes. Had they noticed anything other than the players going on in the video? Halfway through the video, a student in a full-body gorilla suit walks into the middle of the frame, turns and faces the camera, beats her chest, a few times, turns aside, and walks out. 9 seconds in front of everybody who watched the video. Now, the experiment's been repeated many times, a lot of diverse audiences, and the amazing thing is about half of us never see the gorilla. We're so focused on what our task is at hand that we don't notice this very bizarre event going on right in the middle of everything. They've tweaked the times as well to change the color of the gorilla suit. They've tried it without people. They've tried it moving letters, digitized letters on a video, and we all still don't do particularly well at this. About half of us miss what's going on. This error of perception results from a lack of attention to an unexpected object. It's called inattentional blindness, and it's the same reason why when there's been an accident on the road and somebody's hit a motorcyclist, the person that was driving the car says, I never saw him. I never saw the guy. Because perhaps the driver didn't expect the motorcyclist to be there. So the illusion of attention is powerful. We think our attention has given us an accurate picture of the world, but we experience far less of our world than we really do, than we think we do. We can be completely unaware of things that are outside of our attention. Steve? There's a parallel here that occurs in the amount of information investors must absorb. In our world, we have to scan the environment frequently, monitor what's going on the computer screens and tables and charts and indicators. Yesterday would have been a fascinating day to try to do that. You can talk to Carrie and Sarah about what that was like. And we need to absorb the news and reporting and analysis that's going on as well. It's quite a challenge at times. So we're certainly at risk of missing important things happening. For investors in general, it's easy to expect more information to translate into better decisions. But the research indicates otherwise. We get overwhelmed with the information that's provided. More information makes us more confident, but it makes our decision-making worse. There was an article just last week in the Wall Street Journal that was talking about the role of disclosure in the investment world. Regulators tend to think that more disclosure is the answer to everything. If you tell investors that there are risks, if you give them all this print, they will find it and they'll say, okay, maybe I shouldn't be investing in that. And the truth is that that's not quite right either. And in fact, the experimenters who did this gorilla study commented about this specifically. The more comprehensive a prospectus seems, the more likely investors are to conclude that all you need to pay attention to is within the four corners of the document. And the effect is one of lulling investors out of any motivation to do additional research or due diligence. So we miss important things that are happening in the here and now right in front of us. How do we do forecasting the future? Our industry is full of forecasting and predicting the future. We have analysts and economists that spend thousands of hours and a lot of money trying to identify what's going to happen in the markets and the economy. And unfortunately, Wall Street is notorious for very poor forecasting and misses. And the reality is, again, that we're not very good at predicting the future. We're affected by a chronic underestimation of the possibility that the future will stray from what we expect to happen. And we don't really even account for uncertainty particularly well in our planning. We certainly fail to account for the black swan event. Why do we struggle so much? Why can't we get a better hold of what the future holds for us? We certainly know a lot, but we have a tendency, a built-in tendency, to think that we know more than we really do. And enough of that tendency can actually get us into trouble. We venture into securities we don't really know, and we are overconfident that we've done our homework well on a stock. We're fooled by reductions and randomness, and we use flawed tools of inference. Our beliefs, for example, act as a simplifier, and they allow us to neglect a great deal of information. We use sampling and statistics and a lot of mathematical models, and they give us too much confidence. We place too much confidence in those models. We think that all